Hello and welcome to the Portfolio Matters Week 18 Weekly Update. Before we move into the update, here's Keith with our disclaimer.
Thank you, Richard. Everything discussed during the Portfolio Matters podcast is for informational purposes only and should not be considered as investment advice. Listeners should be aware that we will be discussing securities that we own or have a financial interest in. Please do your own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. A full disclaimer can be found at the end. Take it away, Richard.
Thank you, Keith. So, the week's events. Janet Yellen warned that interest rates may have to rise to prevent overheating. Tech sold off. The following day, she backed off and made some excuses about how she wasn't sure what the time frame would be. And Keith, what were the effects on the interest rate markets?
Well, precisely zero, frankly, as you will see later on in the checklist, that rates actually came down during the week, which continues to astonish me.
So probably more of the jawboning to try and manage the economy rather than having to do anything. And UK mortgage lending hit a record 11.8 billion in March, the highest since records began in 1993, showing a hugely active UK housing market.
But again, Richard, I mean, that's showing the effect of very low interest rates and everyone's got money in their pockets.
Yeah.
Money is coming into this economy.
And the stamp duty holiday as well, I think, is people are trying to sell before, to transact before the stamp duty holiday ends, although it constantly is being put back. Keith, what's this one?
Well, I thought this was very revealing. This is Nordea's inflation model. And, you can see the dark blue line is their model of US inflation, and US CPI is the light blue line. And what they're saying is inflation is coming big time.
That is actually frightening, because a lot of people are saying, well, we can manage 2, 3, 4% inflation. That's all that's going to happen. This is saying it's going to be twice that much, and it quite possibly is going to stay twice that much for a considerable period of time.
Yeah, I mean, I just don't know what interest rate markets, bond markets are smoking, frankly. I see inflation everywhere. And just anecdotally, I have a cousin in the US who is an entrepreneur, and he is redeveloping various bars. And he's saying that when he's come to restart building work, he thinks prices have risen 30% for the redevelopment.
I think the interest rate markets seem to have decoupled from the inflation rate projections.
Yeah.
And we've talked about this before. Is it because of central bank manipulation in the background? Is it that they think this inflationary push is transitory? We shall see. Small businesses remain closed across the US. I mean, this is a different representation of the chart that we sometimes look at. And it shows that small businesses are simply not reopening. And I guess, Keith, the question is, will they reopen and when? Because in many senses, the US as a nation is opening up after controlling the pandemic with its vaccine program.
Yeah, no, I agree. I think this is an amazing chart, actually. And it shows that, in New York City, 42% of small businesses remain closed. But the flip side of it, Richard, is that we know actually new business creation in the US is very strong. And the banks are willing to lend. There is lots of money around. And I think a lot of these small businesses will come back. And another way to look at this is that, look at commodity prices. While there's a lot of small businesses, and presumably medium-sized businesses, who are not yet open for business. And when they do come back for business, there's going to be even more demand for commodities.
There is, I guess, there's another way of looking at it, which is this I'll edit this bit. Is this a forewarning of a stagflation effect?
Yes, absolutely.
Keith, what was this one showing?
So this is one of the interesting things about Q1 earnings in the US was how some of the big tech companies massively beat earnings, but then their share price actually went nowhere. In fact, they fell. And what that tells you is the market has fully priced it in.
Yeah. The US collected less corporate tax in 2018 than any other OECD country. So tax rates could potentially have a long way to rise before it affects the competitiveness of the US economy. That is interesting, isn't it? In fact, look at Australia.
Yeah, I mean, and whenever you get try and raise tax, you get lots of pushback from the corporates. But really, frankly, I don't think they've got a leg to stand on.
No, I would agree with that. And it's interesting to see that France and Germany are lower than the UK, because I would have said that was the other way around.
Yeah, no, that is really interesting, actually.
Okay, so this is a Chicago Business Barometer, which was published just the other day. Obviously, it shows that it's accelerated to 72% in April, which is a sign of overheating, you would think, and maybe interest rates should be going up as a consequence of that. Obviously, they're not. But the key point for this, what I picked up, was that prices paid at the factory gate skyrocketed a further 11 points in April to a 41-year high. Raw material shortages and transportation problems continue to weigh on companies' cost burdens. Central banks continue to say that the inflationary pressure is transitory, but every week we report more evidence of rising prices.
Yeah.
Keith?
And well, this is it. Input prices are going through the roof, but we will get onto this further when we go through the commodities checklist. But look at this. I mean, frankly, I look at a lot of these commodity charts, and I just get a feeling of fear at the pit of my stomach. I mean, this can't continue. This economy is not, the sum of the parts does not add up. You cannot have massive inflation in input prices and bond markets not expecting any inflation at the end. It's just absurd.
Commodity price momentum. You can see that the price momentum for commodities is the highest it's been since the mid-1970s. And it's almost equal to the median figure in the mid-1970s. So we historically are in a very high momentum region for commodity price increases. And look what it has been for the last 10 years. It's really been very low.
Well, I mean, that is in part the problem, Richard. It's been low, nobody's invested, and now, we're opening up, everyone wants stuff. There's no capacity.
Now, I think we looked at a version of this graph a few weeks ago, I recall. I think this is really quite frightening. So this is the FAO, I can't remember what it stands for, Food Price Index, and it was published a couple of days ago. And this graph, I think, is particularly interesting. So it shows the food price index in nominal and real terms. So if you look at it in real terms, which is a yellow line, it is as high as it has been, as it was in 2010. And the next time it was at this level was in 1975, which we know was a period of significant inflation. And food price inflation, I think, is around about 30% for the last 12 months, which is a dangerous level.
It is. I mean, the Arab Spring was in part caused by high bread prices. And one of the companies we are going to cover next week, Serenus Energy, has assets in Tunisia and a history of social unrest there.
Keith?
Well, the next two charts tell a story. Order backlogs are at a record high, so companies are not they've got lots of orders they can't fulfill. And if you move on to the next chart, Richard, so customer inventories are at record low. So, there's a big order backlog, and there's very strong demand as well, which is not being fulfilled.
And that then leads to price increase pressure.
Yep.
Keith, equity markets checklist.
Okay, so good week for equity markets. FTSE up, all share up 1.8%, which I think we finally had some outperformance by the all share compared to the S&P 500, as some of the air has begun to deflate from the tech bubble in the US. So you saw the NASDAQ underperforming, down almost 3%. The S&P flat on the week. Sorry, Richard, you go back a sec. And Topics was up 1.3%. That's Japan. Bitcoin had a good week, up 4%. And the sterling down 0.2%. If we now look...
Sorry, Keith. I was just going to say the FTSE 100 seems to be settling above 7,000 now for the first time in a long time.
Yeah.
And the GBP US dollar virtually unchanged on the week.
Yeah. So this is the NASDAQ versus the S&P 500. And you see that after a very strong outperformance over the last year, in the last week, it started to come off. Now, long-time viewers of the weeklies will know that we think that as interest rates rise, long-duration tech stocks should underperform. Now, actually, interest rates haven't risen, but perhaps this is the start of it. It's something to watch.
Yeah. The Buffett yardstick. Market cap,
yes.
gross national product, and it's shooting up. In fact, it's gone up by 50%, well, perhaps 30%, well, 50% in the last year.
Yeah. Well, you know, obviously GNP's gone down and markets shot through the roof.
Yeah. So this is your graph, Keith. Do you want to tell us about it?
Well, Richard, I was just thinking that perhaps you might want to, take even more profits from your Bitcoin position because money seems to be flowing out. Actually, I see a lot of contradictory stuff on this. Actually.
Yeah, it seems to have stopped flowing in, doesn't it? But it hasn't really started flowing out yet. I noticed the graph is very slightly below the zero line. So we've got a bit more on Bitcoin. As we saw above, Bitcoin had a reasonable week. It's still below its high of 65,000, 66,000. The Ethereum, however, has had a very good week, and it's gone up by 10% or so. And it's also showing a very different graph to Bitcoin now. It seems to be, in relative terms, it's shooting ahead. And it's quite interesting to possibly understand why. So this is a graph of activity on decentralized exchanges versus activity on centralized exchanges, spot trade. So effectively, back in January 19, all of the activity was on centralized exchange, and there was nothing on decentralized exchanges. In September 20, it peaked at 20% on decentralized and 80% on centralized, dropped back down, and now it is climbing back up again. So the point of this graph is that decentralized exchanges use Ethereum to run the blockchain contracts. So this is a sort of a surrogate for Ethereum use in the real world. And it's interesting to note that Ethereum use in the real world has picked up from 2% in May 2020 to 12 or 13% now in this particular sector of exchanges on the sector of exchanges. So that sort of might explain why the enthusiasm for Ethereum, as it has a real world use, as opposed to Bitcoin, which is the store of value.
Actually, before you go on, Richard, I've got a question for you. So, in recent years that the US has increasingly been using the US dollar system to impose or to execute its sanctions on various countries around the world. I mean, could you use Ethereum or Bitcoin to evade those sanctions?
Well, I think the answer is probably yes, you could. I mean, I think you can use Bitcoin because Bitcoin Bitcoin's decentralized ledger is not controlled by the US. I mean, the US control the SWIFT system, don't they? And that's how they can use it to sanction nations by blocking international international transfers. And but yes, I think you can. Although, of course, as they talk about regulating exchanges, which coincidentally, we had Gary Gensler appeared before the House Financial Services Committee on Thursday and suggested that Congress should consider regulating cryptocurrency exchanges. Basically, he was saying that there's really no protection from fraud or manipulation. But of course, governments hate to have unregulated financial transactions of any description going on, because governments consider it their right to regulate all of these things. And you have to view the desire to regulate slightly cynically, and saying it's for the good of the individual, possibly not including the statement it's for the good of the state as well. Sorry, that's my sort of...
Well, you're right. If countries do try and use crypto to get round the SWIFT system, then you can see the US will try and actually bring it into their orbit by regulating it.
Yeah, exactly so, Keith. And here's the shit-perp, our favourite chart, the shit-perp crypto chart. As we can see, has perked up a bit in the last few days. And good for it.
Well, the performance of this is another reminder of how little I know. It's kind of, I'd have sold this every week for years. You
wouldn't have bought it. I mean,
exactly.
It's fair to say that you wouldn't have bought it. So, okay, industrial commodities, aluminium up 3.5% on the week, which is an extraordinary jump, isn't it, Keith?
Well, this whole table, Richard, just frightens the life out of me. When we go through the charts, you'll see. Do you want to do this, Richard?
Yeah. So cobalt's down 2.8%, copper up 2%, iron ore up another 2.6%, lithium unchanged, neodymium unchanged, nickel up 4.2%, and we don't even believe there's a nickel shortage at the moment, do we, Keith?
Yeah, absolutely.
Ferrovanadium unchanged, WTI up nearly 1% on the week, and uranium down nearly 3%.
However, on the uranium, Richard, I noticed there is a difference between the data I'm using and the charts you were using, which showed different results. So some caution there.
Yeah, they may pick the data up from different sources, mayn't they?
So this shows speculative positioning in copper, and it shows it's coming off. So at least some of the financial traders think that copper may have come too high. And if you look at the correlation between the lines, actually there has tended to be a link between speculative positioning and the price. So this may be a sign that the price has come too far and we're going to have a summer pullback in copper.
Yeah.
And further on that, this is Chinese credit impulse, which is fading. And that, again, tends to lead copper. So if the historic relationship were to hold, you'd expect to see copper continuing to rise for a little while, then coming off strongly.
Yeah. And there is the price of copper continuing unerringly upwards.
Yeah.
If it were to pull back according to those charts, Keith, you might expect a 10 to 20% pullback, mightn't you, to maybe 420, between 370 and 410 as a possible pullback.
It's an absolutely extraordinary chart.
Yeah. The copper supply could be constrained by a shortage of advanced projects. These are really interesting charts. So the graph on the left is a production profile for probable copper mine projects in 2008. So you can see that there was a significant prospective supply of copper coming through over the next 8 years or so. And if we now go to where we are in 2020, there is probably a third of that amount of supply coming through, when we know there is also a huge demand building up for copper with the greening of the world's energy system. And there simply doesn't appear to be enough advanced stage projects for future copper production. And So on that vein, copper must rise 50% for miners to accept extra risk, says Glencore chief. That was in today's Financial Times. Basically, what he's saying is the copper price needs to go up for miners to increase their exploration activities and development activities, but must go up from 50% from where it is. And without going through the list in detail, this is quite an interesting list of potential drivers of the new commodities supercycle. Lots of reasons why these commodity prices may well continue to go up. And then there was a report published by the International Energy Agency this week, which a couple of extracts from it. Countries should consider stockpiling some of the critical minerals to hedge themselves against supply shortfall, said the head of the International Energy Agency. It is not a bad idea. Some countries will build voluntary strategic stocks, which could be helpful, especially for some of the critical minerals that are highly concentrated in a very few number of suppliers, he noted. In other words, governments should hoard these metals. And then the group of raw materials used in batteries is expected to go on the biggest surge in demand, report said. Demand for lithium is set to grow more than 40 times if countries want to meet the goals of the Paris deal, which just suggests there's extraordinary tightness in the market for these metals.
Well, can I come in there, Richard? I think that is an incredibly irresponsible thing to say. When I was doing my economic history masters, I was reading quite a lot about famines, and Amartya Sen's description of the famines. And essentially, in most famines, there's enough food. What happens is that people worry about future food supply and they start hoarding. And they take all the food out of the markets and the poorest people can't afford it. And actually what he's saying is, in the market for lithium, you should all do that. And actually what you do is bring demand forward and the price goes through the roof. I mean, it's just totally irresponsible.
I agree, Keith. And given that it's the International Energy Agency, he's telling everyone to hoard. Well, everyone can't possibly hoard, can they? Yeah. As you say, there isn't enough supply and the price will simply go through the roof. So this graph, which Keith found, is a very interesting graph, shows copper demand growth, supply elasticity under stress. Basically, there isn't very much supply elasticity at all. And there are different sources of supply. So the large blue sector at the bottom is the base case capability, what we currently have. And then layered on top of it are probable projects, other possible projects, off-radar projects, lower risk projects, so forth. But what you can see is that the demand for the accelerated energy transition scenario far exceeds the supply, even if all of these possible sources are incorporated into production, let alone if only some of them are. So one of our podcasts earlier on, we were talking about metal substitution. And one sort of starts to think here, well, are we going to have to start finding all sorts of substitutions to replace metal that simply isn't going to be available to achieve the objectives set for climate change? What do you think, Keith?
Well, I think in that piece we were talking about how much substitution there had already been in things such as domestic plumbing. And I think that will continue. I mean, the thing I was going to add, Richard, is that, this week we covered Excelsior Mining. And what really struck me about that presentation we did was how long it took for them to get that mine into operation. It was 9 years from initial drilling to permitting, funding, building it. And, the other things we've covered in other weeklies is that, when you look at the grades they're now mining in copper, they're tiny. I mean, 0.4% in Peru. I mean, you have to move a hell of a lot of rock to get your copper out. So I would worry about how much future supply is there at current prices. And I think the price will have to rise.
And that's probably what the Glencore chief was referring to when he says the price needs to rise significantly to make these lower concentration resources economically viable to explore and exploit.
Yeah.
Keith, you want to talk us through this one?
Well, this just again is showing you the sensitivity of all the different metals to increased demand growth from essentially clean energy. And you can see that copper is going to require, there's going to be a lot of increased demand relative to 2020 and 2040. Essentially, the thing you need to take away from this is that you're going to need what? An extra, almost double the copper. And in lithium, you're going to need almost like, is that 40 times as much?
Yeah.
You know, cobalt, you're going to need what? 10 times as much?
Yeah.
You're going to need a lot of this metal.
Yeah. Electric vehicle prices fall. Keith, I think you wanted to talk about this, didn't you?
Well, I love this chart. I mean, this is human ingenuity in action. And it's just this. So this chart here is the price of lithium-ion batteries. And, you know, they're just collapsing in a straight line as technological improvement. And what this chart is essentially saying is that as lithium-ion batteries fall, so the price of electric vehicles is going to fall. And they're now saying that by 2023, electric vehicles are going to be the same price as internal combustion engine vehicles, which I struggle to see, actually. But, you know, anything's possible. And then by 2025, they're going to be cheaper. And when that happens, the electric revolution takes off.
Yeah. It's the last piece of the jigsaw, isn't it?
However, I would say that lithium-ion batteries, you know, is dependent on not just the price of lithium, which is a tiny portion of the batteries. People don't understand this, but it's less than 1% of a lithium-ion battery. The rest of it is nickel and cobalt and copper. Actually, not copper, but, you know, other stuff. You know, so as the price of metals go through the roof, it is counteracting this.
Yeah. Interesting. Keith, do you want to take us through the oil slides?
Yep. So, crude inventories. Now, crude inventories are falling again in the US, which is great for me. And what this shows is that surplus crude inventories in the US are back to average levels. And if they keep on falling from here, that is bullish. Now, remember, OPEC are completely in control of this market, and they have surplus they can bring on. And if they were to do that, inventories will keep on rising. But right now, the market is in deficit. Next chart. And this is a chart which combines information from the EIA and IEA, and it's forecasting that world oil production will not return to its January 2020 levels until mid-2023, 24. So if demand comes back before then, prices are going to fly.
Interesting. This is a graph of spot lumber prices, which is just extraordinary. And you do wonder, looking at this chart, at what point it's and how fast it's going to pull back towards the sort of below $1,000. But it is just an extraordinary chart, Keith.
Yeah, it is. Frightens the life out of me.
Okay, so this is one of Keith's chart. China import ban continues to impact Australian coking coal prices. Now, we were talking about this a little bit earlier, and as Keith pointed out, coal is fungible. In other words, there's certainly so much coal around. If China doesn't buy it from Australia, they buy it somewhere else, and someone else buys it from Australia. So we're a little bit puzzled as to why the price is dropping, since we don't believe that demand has particularly dropped. Isn't that so, Keith?
Well, absolutely. If you look at, Chinese iron production, steel production, it's going through the roof. So, where are they getting the coal from? I don't understand.
I was looking the other day at substitutes for metallurgical coal in steel production or processing of iron ore. And there is one way of substituting it, which is you can use pure hydrogen created from, most hydrogen is currently created from hydrocarbons, i.e. fossil fuels, so that doesn't work. But if you can create sufficient hydrogen using clean energy sources, then you can substitute the pure hydrogen for coking coal. Because I have an investment in colonial coal, which is metallurgical coal, and I was slightly concerned that they might be that the demand for metallurgical coal might be knocked out by an alternative, greener method. But actually, there isn't one unless you make hydrogen. So,
well, I think you're in trouble, Richard, because BP are trying to harness fairies to produce lots of hydrogen.
that why the price has gone up, Keith?
Yeah.
Price of aluminium, iron ore, cobalt has fallen back a bit. Nickel started to climb again.
Yeah, it's come back.
Yeah.
You know, all these charts just frighten the hell out of me. You know, how can you not say inflation's coming? It just mystifies me.
Yeah. Precious metals. So gold up nearly 3% on the week, silver 5.5%, platinum 4.5%, rhodium 1.4%, and palladium virtually unchanged. So a good week for the precious metals.
Absolutely. But then, you know, as we'll see later, rates came down. I mean, mystifying. But the gold chart looks great. You go, Richard.
Yeah, so I like, as you know, I like my little bit of chartist analysis. So I just drawn some parallel lines, and there's this, the downward trend has been broken. It was broken actually, obviously, in early 2021, but it has been broken again. And the question is that sustainable? And if so, but it's looking much more positive than it was a month ago. This is a chart of gold and silver miners with percentage of miners with positive free cash flow annually. In other words, they're making money. So back in mid-2018, only 30% or so had a positive free cash flow. And now 73% of them do, and that you would expect, given the recent increase in precious metal prices, that's going to go up. In other words, a lot of metal miners are starting to become cash flow positive. And that is obviously bullish for the mining, gold and silver mining sector. And hopefully they will spend it on dividends rather than futile speculation, which is what they did 10 years ago.
Yeah, which is what they always do. But we're perennial optimists.
Yeah, or mugs, I'm not sure. So this is a graph of gold versus CPI, and I cheekily put my own line on it. So my line is the red line with the arrow on the end. So if you plot gold versus CPI from 1975 until now, gold's gone up 829%, gold 410. Gold 829, CPI 410%. There is a lot of skepticism about how CPI is calculated with these hedonic adjustments and so forth, which are very peculiar, leaving out housing costs, leaving out energy and food costs, which we just saw went up by 30%. So I have an alternative interpretation of this graph, which is actually CPI is more like, over the period of time, is more like 700%, and it fits the graph of gold quite nicely. What do you think,
Yes.
Keith? This is a dodgy gold chart, by the way.
Yes, of course. It's traditional. We always have a dodgy gold chart, but I agree with you, actually. I mean, the hedonic adjustments to the CPI, I mean, reality is, you know, I think people's lived experience of inflation is much higher. It depends on what your basket of goods is. And in particular, we both know over the course of our lifetimes, you know, the price of a pint of beer has gone up, you know, 5-fold, 6-fold.
I remember my father, he would have said this about 40 years ago. He said, when the price of a pint of beer hits 50p, he would stop drinking beer. And that was when it was about 30p a pint. I remember buying it for 28p a pint in the Students' Union. He didn't stop, by the way. It was an idle threat. There's the silver price chart. Silver is in this big triangle, and it looks like it might be heading for a breakout above the triangle. And if it does, then the chartist would say that's a very bullish sign.
Yeah.
Keith would say, nonsense, look at the interest rate.
Well, I own Hochschild and, you know, quite a few silver miners, so, you know, great.
Platinum, in high demand for exhaust system catalysts, and presumably the demand for platinum will tail off, won't it, Keith, as the electric vehicle becomes predominant?
Well, you'd think so. Yeah.
Palladium.
In particular, I think palladium and rhodium, you'd say absolutely.
Yeah. The rhodium looks like it might be heading for another run up shortly. And yields and rates. Keith, would you like to take us through yields and rates?
Well, this is another thing that just constantly mystifies me. How can rates be coming down when we are seeing inflation absolutely everywhere? And so last week, even after Janet Yellen's comments, rates came down. The 5-year came down 4 basis points, and the 30-year came down 2 basis points. Mystified.
Yeah.
Do you want to skip on to the charts, Richard? Yeah. And this chart shows that inflation expectations remain subdued. I mean, when people actually start spending money and they find that actually everything is much more expensive, I really think this is going to rise and rise quite sharply.
I wonder
the question will then be,
who do they ask, for their inflation expectations?
Yes, that's a good question. Good question, Richard. Yes. And so, actually, when you look at the 30-year, it did have, it's come down from a little mini peak last week, but you could say the trend is rising slightly, but still, it remains very subdued, mystified.
Yeah.
Yeah.
And the 10-year...
Yeah, well, the same here,
Yeah. So the futures continuous contract seasonality, and we're now in early May, and it seems to be working, Keith.
Yeah. We should give up, Richard. We don't need to say anything, just follow this chart. Although it does say essentially we should stop podcasting for the beginning of June.
Yeah.
And come back mid-October.
Yeah, that's a good point, actually. Stop in June and go away.
Yeah.
Okay. And Keith got this graph. Generally, the first couple of weeks in May are positive for the market. Well, we've seen that in the first week so far. Keith, would you like to go through your weekly activity?
Thank you, Richard. Well, I had a decent week, actually. My P&L was up 3.5%, and that takes me up 7.5% on the year. So I am still lagging the all share, but energy stocks started to move last week, which was good for me. Now, I didn't sell anything, but I bought a few things. So I bought more James Fisher and Sons, which we are hoping to do a share talk on over the next couple of weeks. My long-standing limit order in Entech Upstream was hit. And I also bought some Excelsior Mining, which we have done a share talk on, and I think is very interesting, and I hope everyone will take a look at that. Techmar had problems this week. So I'll go through that in a sec, because I have a chart of Techmar. And I bought a little bit more Advanced Energy. But the big things that's happened in my portfolio over the week is that everyone who's followed our podcast from the start will know that one of our big stocks we like is Rambler Metals. Now, its shares are down 20% today. Now, a couple of weeks ago, we talked about Rambler, and we noticed that they had changed their guidance to get back to full production at the Ming mine from beginning of Q4 to sometime in between September and December. And we warned that this may well be a sign that they were going to downgrade production further. And that downgrade came today. So they have said that they will aim to get production back by the end of the year. Also, they provided their Q1 revenue numbers, and unfortunately, they're still suffering the effects of the refinancing from last year, in which they were forced to hedge a lot of this year's production. And so they sold 263 tons of copper at $5,820 a ton. Now, bear in mind, copper is currently almost $10,000. It's over $10,000 a ton right now. So that really hurts. And they then have a lot hedged at $7,700 a ton. Now, they are selling some in the market, I noticed, because if you add that up, the copper they've sold via the hedges amounts to 6 million, and they're reporting revenues of 7. but they've got a lot still to sell under the hedging contracts which were forced on them by Westface Capital in December. But the other thing to worry about, frankly, is they've said they, having already raised money this year, they are searching for further financing, although they have said that they have received interest in some of them other mines. So something to watch, but the shares are off 20%. Now, frankly, this is a turnaround story. If you expect it all to go smoothly, they don't. So, you know, I bought a bit more this morning. I think the core story remains intact, but there are going to be teething problems. You know, but the whole point of these turnarounds is that the potential reward is very high, but you don't get there in a straight line. And you'll expect that there may be some dilution, so you don't get all of that, but it's a potential multiplier.
Excuse me.
And this is the share price, which is, you know, it's having a bad day, you know, but we started recommending it down here. It's up a third, you know. So now Tecmar had problems. Orsted came out during the week and said that they had having problems with their cables on their wind farms and took a 350 million euro provision. And Tecmar had provided the cable protection systems. Now, if you look into it, it seems it was the way the cable protection systems were installed. And this is a learning process for the entire industry. Now, Tecmar shares are recovering, and I think they remain seriously undervalued, and I bought a bit more. But I also noticed the spread was absolutely enormous this morning. So, you know, this is something to watch. And Ferro Alloy Resources, I mean, the share price was not looking very happy, frankly. It had come right off from a high of 45p and down to 30p, and it's had a bounce this morning. But, you know, again, these turnaround plays, the share price does not go up in a straight line. Richard, your turn.
Thank you, Keith. So my weekly update, Keith, I had my portfolio was up by 3.4% on the week, although it says 3.1 in the spreadsheet, so it's actually 3.1%. My apologies for that. A chunk of that was due to the recent resurgence in the price of gold and silver. My gold and silver mining shares did well out of that. So this week I purchased a holding in a KFA Global Carbon ETF, which I shall talk very briefly about in a moment. And I also bought a small holding in Excelsior Mining. I like it. I think the presentation was really interesting. And I just want to watch it, really. And I find a good way of watching a share is to have a small amount in my portfolio, keep an eye on it. Makes me look at it regularly, not lose sight of it. Now, contrary to Keith, I sold my Tecmar. And the reason I sold them was because when I saw the news, I thought there is potential for serious litigation here. I don't know if it's going to happen. I don't want to be involved in it. And I think without this potential litigation or claim over it, Tecmar is a very good prospect. But I just don't like the idea of it having this uncertainty hovering over it. And the actual size of the claim, 403 million euros, obviously it's not all against Tecmar, but if a chunk of that came Tecmar's way, it would be very significant in terms of its market cap. So I just thought I would like to be out of this for a while and see what happens. So KFA Global Carbon ETF, the purpose of this is basically this invests in carbon offset permits. And there's a European system, and I think there's an American system. And the point of these carbon offset permits is that a large industrial carbon producer has to buy a carbon offset permit in order to be able to produce what they produce, the quantity of carbon that they do. And the market size of the carbon offsets is slowly being reduced by governments. In other words, the offsets will get more expensive to purchase. And obviously the consequence of that is that producers will be endeavouring to reduce the amount of carbon that goes with any sort of manufacturing, energy production, steel production, or whatever. So the concept here is that the price of these carbon offsets is going to continue to go up for a number of years. It's not going to skyrocket, it's not going to rocket, it is just going to carry on going on a continuous trend. And so I thought it was quite an interesting thing to hold. And as you can see, it has, since the beginning of the back end of last year, it's just gone up in a steady straight line. And it's a little bit like the demand for these things is going to go up and the supply is going to go down. And it's a deliberate regulatory strategy. And there is also talk of introducing carbon offsets, the necessity to purchase these things for things like residential heating. Obviously, that's a few years out. So we shall see, but that's why I bought that.
Interesting.
I wanted to talk about ferroalloy resources, same as Keith. As you know, it's gone up, I think it's up 10 or so percent today. But, and I mentioned this before, I use Fibonacci retracements just to sort of steady myself down. And if you look at the Fibonacci retracement of ferroalloy, it's really only got to the 382. In April, it actually hit the, went below the 50% retracement, bounced back up, and now it's down at about the 382. So in terms of the size of the original move, which was very large and from a low base, it hasn't retraced. At this point, it's retraced less than 50% of that move. That's perfectly normal. And while it feels unpleasant, it is to be expected, and it's not a reason to sell the shares. It doesn't indicate there's something going wrong in my mind. And I don't want to buy any more. I've got enough in my portfolio, but I am comfortable holding them. So Geiger counter, which is I wanted to do this as a chart as well. Geiger counter, which is an investment trust that invests in uranium miners. Very volatile. You see how it went from this point 32 down to 25, which is a 25% drop. 25% up. Down about 20, down 20, 25%, very volatile. But you put it in these parallel trend lines, and it's just bouncing around between the two trend lines. Helps settle you down, helps settle me down to know what's going on. And then Rambler Metals, I did exactly the same thing this morning, and it went down hard, as Keith has talked about, but it is now somewhere between the 50 and 60%, 618% retracement, which is perfectly normal for a large move. Now, I know the retracement has been triggered by news, but it's normal for a large move. People know that these little mining companies will give out bad news on occasions. Their funding will go wrong. It will be more expensive. Inevitably, and I have to say this from sort of personal experience in a sense, directors of businesses try and see things in a positive light because that's what your job is. And you try and promote the business in a positive but fair light. So there's more chance of things going wrong than right, or wronger than anticipated than righter than anticipated. And I think Rambler is just an example of that. So again, I don't want to buy any more, but I'm comfortable with this at the moment, and that just helps keep me settled. And just a short note on lithium Bacanora. So Bacanora has had an approach, I think, as opposed to a formal offer from Ganfeng to purchase its remaining shareholdings in Bacanora, the remaining shares in Bacanora. As we know, Bacanora owns 50% of the Zinnwald project, some of it through Zinnwald Mining and some directly. Zinnwald is based in Germany. Zinnwald Mining benefited substantially from the Bacanora uplift a couple of days ago. My question is, how happy will the Germans be to have the Zinnwald lithium mine fall into the hands of the Chinese? And I suspect the answer is not very happy. What they could do about it, I don't know, but I think it's probably a bit of a watch this space. I also think that if the demand for lithium is going to be 40 times higher in a few years' time than what it is now, it's holding on to these lithium miners is a very sensible thing to do.
Yeah, well, I had a tiny position in Bacanora, and I was looking to see it drift down, hopefully pick up a bit more, and then start analysing it. And obviously, that strategy has been completely blown up now. So I will have to search around for another lithium miner.
Yeah. Oh well. Give you something to do, Keith.
Yeah.
Right. Well, thank you very much, everyone, for.
Sorry, Richard.
Yes.
You've got to mention our poll.
Oh,
We're going to do a poll this week.
We're going to do a poll. We're going to do a YouTube poll on, are we in a new commodity super cycle? And apparently YouTube polls are a great way of getting your name better known and getting more views. So please participate in the poll that we'll put up with this video shortly, and tell us what you think about whether or not we're in a new commodity super cycle. But other than that, I think we're all done. Thank you for watching, and hope you enjoyed it. And if you did, please press like. If you didn't, please also press like, but tell us why not. And we look forward to seeing you. Oh, you need to subscribe as well if you're not subscribed. And we look forward to seeing you with further updates next week. It's goodbye from Keith Jordan.
Goodbye.
And it's goodbye from me.
Goodbye from Richard Wheater, sorry.
Goodbye.
Bye.
Full disclaimer. The material and information contained in this podcast is for information and entertainment purposes only and should not be relied upon for making a business, legal or any other decision. We may own or have a financial interest in any securities mentioned. Listeners should conduct their own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Whilst we endeavour to ensure that the information presented on the show is correct, we make no representations or warranties of any kind, express or implied, with respect to the podcast and website or to any information, products, services or related graphics discussed or presented in the podcast or website. Any reliance you place on such material is strictly at your own risk. You are solely responsible for the investment decisions you make. We will not be responsible for any errors or omissions in the podcast or website, including in articles or postings, for hyperlinks embedded in messages, or for any results obtained from the use of such information. Nor will we be liable for any loss or damage, including consequential damages, if any, caused by a reader's reliance on any information provided by the podcast or website. Please do not listen to the podcast if you do not accept self-responsibility for your actions.